Well, hi everyone. Thanks for joining. We are 10 days past the deadline of when the capital gains exemption was adjusted. What does this mean? We will cover it all in a pretty short amount of time. Actually, today will not be very long at all, and we'll leave a lot of time for a Q&A. So thanks again for joining. Drop your questions at any point in the chat, and we will get around to all of them. We're very excited. So with that, I'm just going to share my screen. Thumbs up if you can see our presentation and these two very interesting political leaders here in Canada who make a lot of big decisions. So thumbs up if you can see it. Perfect. I'll go to full screen. In fact, maybe instead of full screen, I'll go to view as a slideshow. That's probably better. How's it looking? Great. Perfect. Okay, so the capital gains increase strategies for you. What does this mean? I will preface by saying that there are actually some pretty decent silver linings of all of this. And the biggest silver lining is that you're here on a Friday when it's 30 degrees outside, looking for ways to work on your wealth and your strategy. And that is the number one silver lining. Of course, on top of the good vibe and good attitude, you will see there are some actual tactical advantages of what this has done. And we're, of course, very curious to see how it's going to apply to your unique situation. So thanks for joining. We have an all-star cast of different professionals to hit every single angle of it. So I hope it's going to be the most kind of holistic viewpoint for you to dig deep, raise some flags, and dig deeper after the presentation. And of course, during Q&A, I'm Paul Davidescu. I'm just kind of kicking things off. Here is the change summary, just to sort of hit you with the main points. So June 25th, 2024 is when the existing 50% capital gains tax rate changed to 66.7%, and that's on gains over $250,000 and all gains for a corporation. So if you are under a corp and you have investments, that's not, the threshold does not apply. It's always been for kind of all gains. Secondly, it's not that the capital gains are taxed at a 66.7%. It's that 66.7% of the capital gains are taxable and added to your yearly income. That can be illustrated, of course, with our fellow accountant and financial advisor in the room in the subsequent slides. But just keep in mind, it does work kind of the way it's worked with other capital gains. Your personal income is taxed through the tax brackets and not on a flat tax rate. And of course, this is the highest for corporations. So you'll see that, there's sort of like a waterfall of how this tax works, and it's through your tax brackets. So you'll see how that works again shortly through an illustration. And you can subtract the costs necessary for selling the property. Don't forget. So if you had renovations, maintenance expenses, commissions, legal fees, transfer taxes, advertising costs, those are all losses that can go against your capital gains and might either keep you under the $250K threshold, or as a corporation, it'll just lessen the blow. So just some high-level change summary stats there that we will dive a lot more into. First on the agenda is, of course, talking about the capital gains change, and then we have Reza next, who will show you a nice illustration to really walk you through it. Tax mitigation for business owners will be after that. Tax saving alternatives to selling your home. There's a lot of ways you do not have to sell your home and still pull out cash for investment purposes or retirement. And we have real estate opportunities from rushed sellers. So what is this doing towards inventory? We'll have that covered by our expert realtor in the room. Here's the gang. We run a mastermind, and we nerd out about these things every month. And this was the most top of mind topic that all of us got from all of our different customers. Even though we do very different things, it all comes down to finances. So we're really excited to have all the pros in the room go deep with you on the things that they do best. And of course, they'll all be happy to connect afterwards as well, as we can't really cover it all in just one short session. Moving on to the mortgage side, of course, we run a residential and commercial mortgage company, and really is about wealth, right? Wealth and quality of life. And we think about like mitigation strategies, and it's about timing. Remember, you do have levers you can pull at certain times throughout the year. And one thing is staggering the sale of your assets, and of course, particularly on the property side. Remember that if you stay below $250,000 on capital gains, it's a threshold every year. So if you can stagger things so you're below that or close to it, to not all do it in 1 year, that can be useful for taxes. Don't forget, there's ways to time things that you sell. property and, of course, a lot of your alternative investments. Secondly, it's to harvest your tax losses, right? So remember that, and I guess it's taking a positive, a negative, but a lot of people who bought stocks during COVID are now probably in the red, right? There's a lot of stocks who have not recovered. For example, if you bought the ARK ETF, you're probably crying a bit like I am. We'll see if it ever recovers. But the bright side here is, of course, that these capital losses can offset some gains. So if the first bullet point here doesn't really apply, and it's something that, of course, you have to sort of do, remember about your losses. And this is not just, it's not just about a home, if that's even a thing that, that you're exposed to. It's stocks, it's ETFs, and you can also carry forward these losses indefinitely, especially if you think you're going to be selling your house in 1 or 2 years. Do not realize the losses now. Talk to a smart accountant like Reza for it, and you can reduce future taxable income. So again, you have ways to time your gains and your losses. So very important things to remember. They're not automatic. The power is in your very capable hands. On the side of mortgage investing, I mean, number one, look, why do people sell their homes? They need money. A lot of us live in Vancouver, and as we know, your house equity keeps growing and growing, even in the most ridiculous of markets and interest rate environments. So you have equity, it's untapped, and in many cases, you're better off refinancing that equity to use for whatever the investment purposes are. So instead of having to sell and having to realize any kind of gain, when you take out equity, that is not a gain. And actually, a lot of entrepreneurs will pay themselves in equity. They'll just refinance out of their house instead of paying money from their corp to themselves. Now, that's more of an Alex and Reza question. Is that worthwhile? But just remember, equity can be used in lots of wonderful ways. And sure, you would do it at around a 5% interest rate, but that could offset a lot of potential bigger taxes. And you just got to open your mind to it and see if it makes sense for you. And again, the whole thing is providing liquidity without having to sell assets and thus trigger big capital gains taxes. So one thing's refinancing. Here's one well-known in the investment world, especially between mortgage brokers, financial advisors, and accountants. It's called the Smith maneuver. It's actually after a family out of Canada that found a bit of a loophole on how when you borrow to invest, you can do additional write-offs, right? So the interest that you are charged on for example, a home equity line of credit, if you use that towards investments and you track it properly, the interest can be, of course, written off, right? So Smith maneuver is one that it's not for everyone. There's actually a great little book on Amazon. It's maybe, about 100 pages. It explains how instead of thinking linearly, which I think a lot of Canadians do, it's like, okay, I will pay my mortgage in 25 years, and then I'll start investing in the stock market, and then I'll do the things Alex is talking about. Well, you've lost 25 years of just paying off debt. This lets you pay off debt and change the kind of debt you have. And again, that's for another day on how you do that. But you can actually invest while you're paying off your mortgage. And if you have a good long-term plan, this could be a swing of $1 million when it's all said and done. As Alex showed as well, over the long term, compound gains can really add up. So something for you to flag and, of course, inquire more about. And lastly, look, there's even, this is a chance for you to think about just different kinds of real estate investing. There's syndicate real estate investing, right? Where, if you don't have time to buy a new property or to refinance, to get another investment property, there's a lot of, hands-off investments where someone else does the due diligence for you. They manage the real estate, and they usually create a pool of other investors to buy, for example, multifamily apartments. So if you live in Kitts or Fairview or anywhere, any purpose-built rental, by the way, usually is actually bought by a pool of investors because of the low supply in Vancouver and the rest of BC. The CMHC Corporation, which of course you may recognize if you bought a home under 20%, you've got that pesky mortgage default insurance you got to pay. But on the commercial side, meaning when it's a big building, they give a lot of incentive to developers to buy multifamily assets to help the supply, and that's changed a lot the last 6 months. So you can take part in that by being one of the investors who puts money into a syndicate, and you can make 15, 20% on your money depending on when you sell, and consult your professionals, of course. But this is a chance for you to think about, how do I do mortgage investing properly instead of having to sell? You can do a lot with your lines of credit and through syndicates. So these are all things that maybe it's a refresher for you or brand new, You won't solve this in one webinar, but these are important reminders in the face of the stress we have with the capital gains tax. Now over to my colleague, Alex, we'll talk about the actual real estate component.
Awesome. Thank you, Paul. So tying into a lot of the things that Paul already said, if you could click one more time, we're just missing one part. So essentially, the first question I wanted to ask when we're looking into the real estate market and specifically capital gains is, is it really that bad? And so if it's under your personal name, I say not really, but it realistically depends on how much equity you've actually built. If you bought a property 10 years ago as an investment, it could be a lot worse versus someone who has built up 250, 300, 350,000 where, you're only being taxed an additional $4,000 to $15,000. Again, it's not great, but it's not necessarily as bad as they may have made it seem. Now, the other side of that is purchasing a property as a corporation. And so it could be a lot worse. And there's a lot of other things that tie into this that I'm not going to get into based on if you're a small business. That's more of an accounting question, but it could potentially be a lot worse. So I think we're going to see a lot more people potentially purchasing properties under their own name. Now, already kind of touched on the other aspects below this, but essentially, if you have $1 million in capital gains, you have 3 options. Hold the property, don't do anything. You can sell it off. And then in this situation, we'll get to in a minute. And then the third option would be to refinance. As again, Paul gave a couple different options with either using that money to purchase an investment property or the Smith maneuver. Now, if you do choose to sell the property and you're going to be hit with the capital gains, as we can see over here, after your costs for real estate fees and everything else, it's going to be about $950,000, which, as you can see highlighted on the left-hand side here, leaves you around $700,000 net. So you really had to decide between the two, but you're realistically realizing the taxes versus being able to borrow against equity in the home and do these other sorts of things. So moving on, I just want to talk about kind of what's going on in the market right now, how it has loosely impacted it, and some other things as well. But the biggest thing is just that we've seen a massive increase in inventory across the Lower Mainland. So both in the Greater Vancouver region and the Fraser Valley. And just for anybody who doesn't know the difference between the two, essentially North Delta to Abbotsford is basically the Fraser Valley, and everything on the other side of the Fraser River is the Greater Vancouver Real Estate Board. So we're seeing record levels of inventory, or not record, but the highest levels of inventory since just prior to COVID. And when we're hitting these peak levels of inventory, as you may probably know with economics, supply and demand, so when we get a large amount of supply, this should put some level of downward pressure and turn us into more of a buyer's market. Now, typically, we're seeing the best opportunities come just slightly after we've hit peak inventory. And it seems like we're kind of heading in that direction right now. Things are slowing down a bit, and typically they do as well anyways as we get towards August in the summer. And I'll show you a couple other reasons why. Keep going, please. Keep going. Next slide. So why are the listings up at this point in time? So one of the reasons was people were trying to avoid this capital gains tax, but when it was announced, there's only like 6 weeks or something for people to actually try and do this. So there was a bit of a rush. Now, most of those people haven't just pulled their properties off the market, so they are still sitting out there. And, that's one of the reasons that is playing into this. Now, there's also new tenancy laws, which were just officially announced yesterday, which is going to make properties more difficult to sell if you do have a tenant in it, because the notice required is now going from 2 months to 4 months. I'm not going to get into that. That's a whole other presentation, but it's definitely, or it did have people currently with their properties on the market trying to get rid of them before this comes into play. Now, mortgage renewals, now that's not necessarily because people can't afford the mortgage or they're under financial pressure or anything else, but if they had locked in for the last couple of years at, let's say, 2 or 3%, and they didn't have to resell, even if they wanted to buy something else, just because of the fact they knew in the future it would be a little more difficult. Now's the time that they're coming to the end of their terms, which, as I mentioned, they already wanted to, so now it makes more sense to do so. Then there are people who are feeling the financial pressure, whether that was over the longer period of time because of the fact that they now have the higher rates, whatever that may be. We're not expecting any like massive influx of foreclosures or anything like that, which you'll see on negative news channels and things of that nature. Of course, there will be a few here and there, but not enough to make a drastic impact in the market. And then seasonality, as we head into the summer, things typically, they slow down, but we kind of hit peak levels of inventory sometime around September typically, and then head down into December. Now, I want to go over the next slide, which is where are the actual opportunities in the market right now. So in Greater Vancouver, what I'm seeing is a lot more condos. So because of all the things that we already just talked about, because of the changes to short-term rentals, this is where I'm seeing the majority of the inventory come, and a lot better deals are potentially coming up. Now, in the Fraser Valley, it's actually the detached market, and more specifically in some of the fringe markets. So when I say that, what I mean is like Maple Ridge, Abbotsford, Mission, Chilliwack. We see the most volatility in these markets, especially detached homes, because when prices go up, they typically get a lot closer to where the price points are in Vancouver. But when they come down, they fall a lot further. And contrary to potentially popular belief, is there's actually more people with larger mortgages percentage-wise in these fringe markets than Vancouver. It's actually closer to 50%, which was very interesting to me to learn the last couple of years. And then pre-sales and assignments. So pre-sales, there's a lot of projects out there, but you gotta be very careful with, there's only certain good ones, but the ability to get into one of those now and not actually have to have a mortgage and get a future interest rate in the next 2, 3, 4 years is giving you a great opportunity. Again, you have to be very careful there, which ties into the next point for assignments. So if you're not familiar with assignments, these would have been pre-sales that people purchased in the past. A lot of people had the assumption that the market only goes up and they're just going to flip them really quickly. Now they're in financial pressure because they can't close on them, which is giving opportunities in the market to take it off their hands, either at the price it was before or even at a potential lower price than they had purchased. And then the last thing, of course, is a personal residence for yourself. So whether that's buying your first home, whether that's putting some money into your home to increase the equity through sweat equity and other things, is always a great option in the long run. But happy to go over any specific investment strategies or potential opportunities for you. We can just talk about that later, but that's all for me, Paul.
Thanks a lot, Alex. So we're doing full circle back to Reza before we wrap up for questions.
Yeah, this was just a detailed slide about the build to sell, but we can go to the next one.
Okay, we'll also be good to analyze afterwards. Thanks for breaking it down. All right, well, we're at action steps. Number 1, Reza.
Yeah, so number 1 is build to sell. That's if you're a business owner and you're thinking of, okay, what do I do with these changes? Because we're mainly talking about today these changes and what to do. From my advice, one of the advice that I want to give is build to sell. That's one. Of course, the other ones is TFSA or RSPs that Alex talked about.
And specifically, building your business to sell means from day one, or even if you're a few years in, you've got to have systems set up. You got to understand what's going to actually sell your business at the best possible exit price. And there's even a book called Built to Sell, which is a very easy read, highly recommended. But the main point again is that the government is incentivizing business entrepreneurship, and they're taxing you way less. So they want to see more entrepreneurship. So this is a bit of an open opportunity to just think about how can I eventually exit my business. And a lot of boomers are thinking about right now, people that are at the end of their business life cycle. It's kind of too late for them to course correct. And in many cases, they can't rebuild certain processes. But you or anyone, really, there's always time. So think about like what that lever means. I have to just add a bit more context because there's a huge opportunity on the tax savings, right? Which is awesome. Mr. Walford, next point.
You're on mute, Alex.
Thank you. So we chatted about a few options, right, to mitigate the impact of these tax changes. The lower hanging fruit, if you're not already, is looking to maximize those registered accounts, your TFSA and RRSP. If you're already doing that, the bigger opportunities are to consider a whole life policy or an individual pension plan, right? And those allow us to potentially cover that future and growing tax liability and potentially withdraw funds from your corp on a tax-free or tax-deferred basis. Again, the current government is making it clear, they're going to corporations for tax revenue. So the more you can do to draw funds out of your corp without, taking a big tax hit, the better. And these are a couple strategies that allow you to do that.
Yeah, wonderful. On the mortgage side, I mean, look at refinancing versus selling your home if you can. There's so many advantages, whether it's into a line of credit or pulling out money as a refinance. Track your losses. Yes, losses are unfortunate, but they can be up to your advantage, and you can time them in the future to offset future gains. So just make sure you keep tabs of your losses as much as you do with your gains. And lastly, it's a golden opportunity to broaden your investing, whether it be with the Smith maneuver, or any other things like syndicates. Like, there's a lot of great investment vehicles, and just look at what's happening in the news, what's being incentivized, more supply, how can you be part of the action.
Awesome. Then I just got 2 last quick points for you. Buying as a individual or corporation, but that's not a question for me. That is a question for someone like Reza, but definitely explore your options and see what makes more sense for you. And then just understanding the current market opportunities based on a number of things, your budget, your risk tolerance, and other things of that nature. And that's about it.
We're at the end. Thank you for everyone who enjoyed and stayed and was active and turned on their cameras. Very grateful. We'll open it up for a few minutes for any questions from either Blake or Donna. Feel free to type it in or unmute yourselves, and then we'll roll into the weekend. We're so grateful you guys could join. I know it's such a tempting sunny day today, so this is awesome. I love it.